Good morning, good afternoon, good evening from wherever you're watching me from. Welcome back, everybody, and welcome back to the channel. I'm Seto Was, and I'm going to be your instructor or your trainer for this entire series. So if you're here, welcome. Today, I'll be teaching you the master strategy using Fibonacci levels. Please kindly watch this video to the end to have a proper understanding of the concept of Fibonacci and how to use it in day trading, because it's actually a powerful tool. I've been trading in this industry for some time now, and you know my trading style. I've been trading with price action, with currency strength meter, with moving averages, and sometimes I trade with trend lines. But for some time now, I decided to increase my win rate, so I decided to test more strategies. So I decided to go deeper into Fibonacci because always I've been using Fibonacci just as a retracement. And using Fibonacci just as a retracement is not enough. So I decided to dive more deeper into the concept of Fibonacci, and it was good I did, because I discovered very powerful strategies that has a very high win rate. So that's what some time now I have been using. But I've not shown you this strategy on this YouTube channel because it's been a while since I was away. Now that I'm back, I'm showing you this strategy. So please, it's a new concept, pay attention to it and listen to me, and please take my advice. Okay, so whatever I'm going to say, pay attention and listen to me carefully. Okay, so that being said, let's begin our today's lesson. Okay, Fibonacci is a very great tool in trading. When you open your trading charts, like the MT5, you realize that let me move here for the meantime. You realize at this part of the chart you can see this indicator called Fibonacci retracement tool. But mostly what we use this retracement tool to do is to find pullbacks. Like for instance, let's say the market makes a low and a high. We want to find the next area where the market will pull back. Then we take our trade, let's say somewhere there. So for instance, let's say market makes a move. So first move, then retrace, then maybe second move. And we want to know when the market will pull back again, or like we want to find a way to enter on the next move. That's when most people choose the Fibonacci level. But all this while, there is something that was very powerful. It can be used that we were not looking at, and that's what I've discovered. And let me ask you a question. Do you think if the market was as easy as this, let's say for instance, let me scroll here, and you can see the market is moving, right? Let's see if you think the market was as easy as, okay, you get up move, and then you get retrace, and you get up move again, and then you enter your trade here and you buy here. Do you think if the market was as easy as that, people wouldn't have been rich, super rich? They will all wait, and when the market get there, they will buy and take the market up, right? And take their profit, right? Because if it's as easy as this, as everybody shows you on YouTube, then the market wouldn't have been there. The forex market wouldn't have been there. The stock market wouldn't have been there, because it is easy and everybody will be doing the same thing, and everybody will be rich and the market will collapse. So it is not as simple as this. This is just a part. This is like a part of a whole trading strategy. It's just one zone, one part. It's not always like that. You see, it is not always like that. So it's not as easy as this. So if you are saying that, okay, then it's easy as putting Fibonacci retracement as we do here, then you are waiting for the next retracement. You wait for it to retrace to, let's say, this point, and you take your trade upwards, and maybe you take your profit there, then everybody would have been rich, right? So we have to look at the places where people are not looking at. You have to look at the concept where people are not thinking. You have to look at some in-depth knowledge where people don't know. That is the only way we have an advantage over the market. Because when we are winning, we are taking somebody's losses. Do you understand what it means? It means that when you are winning, anytime you are winning, it means somebody who is losing to you. The market is equal. The market is 50-50. Let me just go to the board and explain something to you. The market is always 50-50, which means that the number of people who are buying, let's say, let's just say for easy calculation, okay, let's say that there are about 1,000 people buying, right? 1,000 traders who are buying. If the market want to go down or they want to sell, they sell to the same 1,000 traders. That's it. If there are about 1,000 shares, which means if you want to sell this 1,000 shares, 1,000 people must be buying it. You get it? But by which means the market is equal, is 50-50, 50% here, and 50% there. What does it tell us? It means that the smartest only win. That's why in trading, about only 10% make it profitable as traders. Why? Because the rest of the 90% always lose their money to the 10%. That's their profit. So the much knowledge you have, the much in-depth knowledge you have, the more profitable you become. That's why trading is not a joking matter. You can't say that you are just going to wait when the market hits a zone, then all of a sudden you just buy and make profit. Then everybody would have been rich. So it's very good that we look at places where people are not looking at, we look at concepts where people are not looking at, then we develop a nice, powerful strategies from them. That's when we have an edge over the market. Please, are you following me? Good. Because you can't just do something simple and think everybody's doing the same thing and you get a winning trade. No, it's not going to happen that way. Okay. So I realized that using Fibonacci for just retracement is not enough. Your real rate is still not enough. So I decided to dive deeper into Fibonacci levels. You see that when you come here, insert indicators, there are thousands and millions of indicators. Can you see? There are a lot of indicators around. But the question is, which of these indicators can tell you much information? Most of them are lagging indicators. So you must know which indicator is best for you, which indicator you are going to use to trade best, so that you can make an edge of the market. You can see on my chart, I have some indicators here. I have the money flow index here, can you see? And I have the Gator oscillator 2 here. I will go to explain this one to you later, but today let's focus only on Fibonacci and understand the Fibonacci in depth and how you can make profit with it. Fibonacci does its calculation ahead of time, so which means Fibonacci moves before price also move. What does it mean? When you take moving averages only calculate per the movement of the price. So let's say, for instance, market makes move, other move before moving average takes the average. You see, when you say average, it means the calculation for a set of numbers. So let's say 1, 2, 3, 4 candles. Let's assume that for easy calculation for you to understand. Okay, this is not mathematically correct for you to understand. Let's say here is 10, here is 5, here is 15, here is 2. When you take the average, it means putting them all together and summing up together. So moving average indicators only move when price has already moved. RSI also move when price has also moved. But Fibonacci always has a leading edge, which means Fibonacci takes the price data based on the old price charts and makes its own predictions. So that if market read those areas, market is likely to react around those areas. That's why Fibonacci is very important too. So Fibonacci is a leading indicator. Okay, it's a leading indicator because it builds its movement based on market structure. It does not lag like moving averages. So why is it so powerful? It's also powerful because most institutional traders also watch Fibonacci levels. And what are the standard Fibonacci levels? These are the 32%, 38.2% level, the 50% levels, and the 61.8 level. Because most of the institutional traders are watching these levels, which means if you are buying with them, you are going to have an edge. So for instance, an institutional trader is waiting, let's say, to buy when the market goes to a particular point, watching Fibonacci level. So you wait there because that's where they are all watching. Then you take your trade and you have a great edge over the market. So now let's understand the Fibonacci levels and what are the standard Fibonacci levels and what they actually mean. Fibonacci is calculated on mathematical principles, which says that if you take a number, 2 numbers, and you sum them up, you get the next number. So for instance, here 0 plus 1, you get 1. When you take 1 plus 1 and you sum them up, you get 2. When you take 2 plus 1 and you sum them up, you get 3. So this is like a sequence. When you take 2 plus 3, sum them up, you get 5. You see, so the sequence continues. If you take 3 plus 5, you sum them, you get 8. So with this statement, this mathematical principle is able to generate a particular pattern. And this pattern happens in almost everything in nature because nature is built on mathematics. When you look at nature, this same patterns continues. How the universe, the galaxies are formed. Can you see how the galaxies are formed in flowers, in petals? The same ratio, guys. The same ratio happens everywhere, in the shells, in leaves. The same ratio. Even in DNA, the same ratio happens in DNA. Let's take the tree for instance. The same thing. One, the next one, the next sequence, the next sequence, the next sequence. And watch what is happening here. You see that, look at even the part in the edges of the tree respect Fibonacci levels exactly as it is. Are you see, guys? It respects Fibonacci levels exactly as it, which means this Fibonacci concept is a very powerful concept that if anybody is able to dive deeper into it, the market can also like respect this point. That's why they develop those indicators, the Fibonacci indicators. And there are a lot of set of Fibonacci indicators, but the one which is common is the Fibonacci retracement that we have been using. So with this sequence, we're able to generate some kind of concept for us to use to trade, a tool that we are going to use to trade as traders. And these are the standard Fibonacci levels. We have the 0% level, we have the 23.6 level, we have the 38.2 level. 50% is not actually a Fibonacci level, but because sometimes price will trace to that particular zone, we added it to the Fibonacci levels. But 61%, 61.8% is also a Fibonacci level. Then 78.6% is also a Fibonacci level. And then the 100% is a Fibonacci level. So these are the levels we plot on the chart. So when you go to the chart itself, when you put the chart itself, and by default, the Fibonacci has all these levels. But this one, I have customized it. That's why you see it this way. Let me go back to the default properties. By the default, when you look at the levels, we have the Fibonacci having all this level, the 0% level, we have the 38% level, 50% level, 68% level, we have the 100% level, we have the 161% level, a lot of levels here, but I have customized mine to look like this. I'll go to explain to you later. So this level, you realize the market also respects this level. So if you see any swing high and swing low, for instance, let's say where the market is trending. Let's go to where the market is trending. Okay, good. So let's say there's a swing high here, swing low here. You drag them, you realize that you're able to predict at least where the market can retrace to. You realize that the market retraces to exactly at the 61.8 level. So that's why maybe you can take your trade, or you can take your trade at the 50% level and put your stop loss somewhere below. But this is not enough. You see, this one is not enough because market is not going to trend every time. That's why we have to dive deeper into this concept. So from this, we are able to determine that, okay, then if the 50% was not part, but market retraced mostly to the 50%, then we are going to include the 50%. But you see that on my chart, I have only about 4 lines. I have 1, 2, 3, 4, 5. And this one looks more cleaner than the original one. Why? It is because I decided to eliminate the 23.6 level because I don't need it. And I had to eliminate the 78.6 level. I don't need it. So now my chart left it only this, the middle ones, the middle bar, the top bar, and the down bar, the baseline. So you see that it looks very clean. Why don't I need it? Because it's going to get us confused. Mostly, market is able to break through these lines easily, which means it's not really important ratio. The same happened to the 78 level. It's not really important. But the important zone in the Fibonacci concept is this zone, the middle belt. This zone is the most important zone because this is where when the market gets to this 38%, 50%, and 61% is able to resist the market from breaking through, or it's able to help us to set our stop loss behind it. So this particular range becomes our central. Have you seen our central range? Our central range. So that's where our focus is going to be. So on the chart, you realize that I have only the top bar, you see, and the middle bar, the central range, and I have the base bar. But we are not going to use the Fibonacci just for retracement. This is how the concept works. If you take any, let me clean this. If you take, let's say for instance, when we take a chart, and this one we are on, we are USD switch, right? And this can happen in any of the currencies, okay? We're USD switch, and we're in the 15 minutes chart. So if you don't have this line, if you don't have these lines on your chart, they are called period separators. Are you watching them? These are called period separators. One is here, 1, 2 is here. They are called period separators. They separate the chart because Forex is 24/7, but still the market begins somewhere. The market always begins somewhere. So when I bring this cursor here, you realize that exactly at 12 o'clock midnight in the chart, the market restart again. So every chart has it, but maybe originally you don't have it on your chart on your MT5. So you go to properties and you go to show, and it show period separators. If I take it off, you realize that when I come here, there's no separator. So you see the market as one, but the market is not one. The market always begins somewhere. So I go to properties, right click. When you right click, go to properties, then you go to show. Sometimes it can be here. So you go to show, then properties, then you show period separators. So you show period separators and you click OK. Now you see that the market will be separated for you. So even when you go to H1, you still see the separators. You see, when you go to M5, you still see the separators. But we don't need all this time frame. We need the M15 time frame. That's where we can see the market clearly. So you see that this is for the whole day. This area is for the whole day. This was for the previous day. Can you see? This zone was for the previous day again, which means we are now able to see the market as clear as possible. Now, how do we apply the Fibonacci level into this concept? Since the Fibonacci is able to predict what will happen, since it's a leading indicator, and as I said, since it's a leading indicator that can predict what will happen, then we can take advantage of the same concept. So assuming that this area is not there, let's assume this particular part of the chart, which was 24th February, is not here. Then let's say we are here, this is the one we have, and today the day is beginning from this side. Let's say now that today that the day is beginning, right? This is beginning, so which means we have no idea what's going to happen in there. Let's see how the Fibonacci is going to help us to predict what will happen. So you draw the Fibonacci 2. You take from the lowest point of the day to the highest point of the day, then you drag it. So that's what I'm going to do. Ready, go? Fibonacci 2, lowest point of the day to the highest point of the previous day, then you drag it. Have you seen? Lowest point of the day to the highest point of the day, then we drag it. So with this, we are doing this in assumption that this market has not played. But you see, when the Fibonacci is being drawn like that, see how the market is going to react. See how market go to those zones and reacted to those zones. See, market go to these zones and it couldn't break through. Market got here and it reacted here. Market was able to break from this point. Market open here. Can you see there's a long wick here? Market open here, broke out of the range. You see? And now maybe you can take your trade somewhere. I'm going to explain to you later. But now understand that the Fibonacci is a leading indicator that can predict to us what may happen next. The same way, let's do it again. Let's go back somewhere, anywhere at all. Let's stop anywhere, stop. Okay, let's assume that we are stopping somewhere here. The same method. Let's say this was the previous day, so now this day is now about to play. We take from the highest or the lowest, we drag it to the last point and we stretch it. And you see how the previous day reacted towards the Fibonacci lines. Can you see, guys? So with this, we can take a great advantage of this. That's what I've been doing. So watch here. The same principle from the highest point to the lowest point. Then we drag it and look at how the next day market reacted to the Fibonacci. It hit the central Fibonacci levels, and what happened? Now it bounced off. Have you seen? It was also able to reach just almost at the Fibonacci level, and it decided to retrace. So the Fibonacci is a very important level. Now that you understand the concept, let me teach you the strategy. We are going to use a concept called correlation. So now this is what we do. We use the currency strength meter, the C. Oh. We use the currency strength meter, the currency strength CSM, right? Currency strength meter to check which pair is trending or which pair is ranging. That's the first thing we have to do. The next thing we do is to now we apply our Fibonacci strategies. Let's make it Fibo. Then from the Fibo strategy, there's a concept I have to explain to you called correlation. Correlation. I'm going to explain correlation in the whole concept in the next video. But today, let me teach you how to use the concept to trade Fibonacci. USD, Euro USD. Now, let me clean all this. Okay, so from Euro USD, the next correlated pair to Euro USD is the Pound USD. I'm going to teach you on correlation, okay? Later, I'm going to teach you on correlation and how you understand it. But today, just understand how the Fibonacci concept works and how you're going to apply it. So, USD Pound, the correlation pair is the Euro USD. And I'll explain to you later why they are correlated. Let's take any day. Let's take a day like 6th February. Or any day, let's say 5th. So from 5th, we draw from the highest point of the day to the lowest point of the day, predicting the next movement for the 6th February. So we draw our charts even before this day the chart plays. The same thing from 5th to 6th. So the same thing. The Euro USD was what we should have done first. So let's say from here, from highest point of the day to the lowest. This is the highest point of the day. Lowest point of the day is here. Lowest point of the day. Now we drag it to predict what may happen in on 6th February. See what happens. See how market opened from this side. Then the market reacted to the Fibonacci levels. Have you seen? And then at the central Fibonacci levels, the market also reacted here. Guys, are you watching? Market reacted here. When market reached here, the market also reacted here. But let's see if this has any correlation with the other pair. The other pair is the Pound USD. So on the Pound USD, the same happened. See, market reached that zone. Market opened from here. It hit the same zone and then head upwards. Now it hit the central Fibonacci levels, and now it was just able to break out of the Fibonacci levels. But the question is, where do we take the trade? We take the trade where we have the edge on our side. So let's say the Euro USD assets, when they did have encounter with the first Fibonacci line, that is around 115. Can you see around 115? It has encounter with the line. Let's see if the same 115, for us to think whether we are taking the trade upwards or not. Whether this 115 we are taking the trade upwards, we have to be sure that the other correlated pair is also at a support area. So we go to the Pound USD, which is a correlated pair, 115. At 115, where is it? At 115. See, at 115, it was also hitting the same correlated area. Have you seen? So why do we take the trade from the correlated pair? So we take the trade from here. You take your entry here. Stop loss behind the pattern. Take profit target as twice as your stop loss. So let's say if your stop loss is around 200 points, right? Let me say around 200 points, which means your take profit target should be 400 points. Have you seen? Then you take your profit. As simple as that, guys. So this is how the Fibonacci is a very, very powerful tool. So please, in this video, I cannot explain all the concepts to you, but at least I've explained that Fibonacci levels are very important. And look at my levels. Based on me customizing my levels, I have only the base level, the top level, and I have the middle range for the Fibonacci levels. So we are going to trade with, we are going to trade the currency trade meter. Then after we select our best pair, now we apply our Fibonacci, right? Then we apply our correlation strategy and we have a very high win rate. And with this combination, we can get high win rate around 65% all the way to around 75%. Because we are actually sorting out and screening out all possibilities for best chances. This is how we trade as day traders, and I want to share with you. So please, if you've watched this video so far, it means you've done well. Please keep the concept in your mind. Understand that Fibonacci is a very great tool you're going to use as day traders, and it has helped me, and I'm sharing it with you. Read more about Fibonacci levels. Go to Google. Search for information on Google. Please. Search about Fibonacci levels, or just open your chart. Open your MT5 chart or your MT4 chart and start drawing the Fibonacci levels. For by default, when you open, let's say for instance, by default, when you draw the Fibonacci levels, it won't look like this. So let me right click, go to properties, and let me set it to default. So let me go to default. Okay, so by default, it will look something like this. Have you seen something like this? So you have to customize it. So you right click, go to properties. First is the levels. We don't need all the levels. We need only few levels. So we are taking away the 23.6 level. So we click on it, then we go to delete. We want the 38, we want the 50, we want the 61, but we don't want the 73. So we go to the 73 level. Where is it? Okay, let's leave this one like that. Then you go to the lines, right? Then you choose the color you want. I prefer red. Then you choose the thickness of the line, or you can choose thin line like this. I prefer this one, and then click OK. Now it looks like the one we're using. Have you seen, guys? And this is the best tool we are going to use for this is the best we are going to use for this year and the next year, because markets keep changing. The more we learn, the more we are able to adapt to the market and make profit out of the market. Because this is what we decided to do. We can't go back, right? Because there's no other better job than trading. So please, if you've listened to me and taken my advice, I'm glad that you've done so. And learn more, go to Google, read more about Fibonacci. And for the next video, I'm going to explain correlation, okay? For the next video, I'm going to explain much on correlation. So we are building a system, right? I'm going to explain more on correlation so that you're able to now trade with currency trend meter, with Fibonacci, then with correlation, so that you can increase your win rate to a very higher win rate that can make profit out of the market. So if you enjoyed this video, please kindly hit the like button. And if you're not subscribed, subscribe to the channel and come back every time to watch our videos. I'm Seth Owers, and see you next time. Bye.